Hey everybody, welcome back again to the Beyond the Rate podcast. Charlie and Will here in the JCL studios. We haven't had a chance to talk to y'all in a little bit, and we wanted to come back with a recap of last year and then what sort of predictions, I guess more like what to expect moving forward in the state of Texas in the housing market, right?
Yeah, let's look at, 2024 predictions from some of the experts. We'll look at 2025 predictions, and then we're going to look at some data from migration patterns, home prices, some of this stuff that has been top of mind and in the
Right.
reports for the last year or so.
Right.
But yeah, let's look at like 2024 predictions. What you got?
Yep. So basically, I know everyone was all excited, you know, about mortgage rates coming down, all that kind of good stuff. Like the predictions, the problem that we've had the last couple of years is that everyone's predicting every year mortgage rates are going to come down. They're going to come down. And they're just stubborn, right? They're just sticky, if you will. That's a good term that's been used. And we are, we kind of we want to get people to kind of get off of that, right? Like, let's stop with the hopefulness that
Yeah,
rates will come
it's
down.
hoping. Yeah.
Yeah, they might. It might happen, but it's so hard to predict. And I think that one thing that we've noticed is that mortgage rates are dependent on data. That's what it is. And the reason why they're dependent on data is because mortgage rates, mortgage backed securities, which is the basis for the rate, are investments. So
Yep.
investors are investing in mortgages or treasuries or stocks, anything else, commodities. So they're looking at the data to predict, to determine what they're going to do. So it's not that the government or the Fed or anybody else can just set the mortgage rates. It's dependent on data that investors use to determine what they're going to invest in. And so if the data that keeps coming out, number one, is not conducive to low rates, and number two, like you've said a lot, Will, the data is not reliable a lot of times.
Yeah.
So we've seen a lot of that, right?
And the data has been showing that the economy is humming along like crazy,
Right.
which suggests inflation because if everybody's working, everybody's making money, they're creating all these incredible government jobs where they're paying a lot of money to these people. Well, all those people are going to have to buy things,
Right.
and that's going to shrink the supply and increase demand. And so then we're going to have more inflation. And so all those companies that are benefiting from increased prices, I mean,
Yep.
food and toys and new cars and all this,
Right.
they're going to be making more money, more profitable, which means that their share price goes up.
Right. So they think
And
so everyone thinks the data people, the government, you know, math calculator geniuses, whatever, cranking out, analyzing the data, think the economy is strong, when in reality, all of us just, here in the rest of the country outside of DC, we're getting by, right?
yeah,
And so the booming stock market doesn't really translate to what the reality of the situation is. And the
yeah,
problem is that you're right, is the economy's humming along, or so we think, but the inflation remains high, which keeps mortgage rates a little bit higher, right? And so I thought it was interesting that you wanted to kind of go back to what the real crux of it is that we would think that rates would eventually come down, which they didn't because inflation kind of hung around. And we have realtor.com, they predicted rates to be by year end 6.5. Year end it was right about 7, on average 6.8, which it trended downwards. And then the second the Fed started cutting the funds rate, they signaled they're going to stop fighting inflation. Therefore, mortgage rates possibly could go back up. That's what investors are thinking.
yeah,
Um, but they did predict the median home price to go down by 1.7%. It actually went up, right, Will?
yeah. Yeah,
Um,
it went up a little bit. I mean, and it's also more market specific, but
Correct. Goldman Sachs predicted mortgage rates to trend
Yeah.
downwards, expected to fall to 6.3% by year end. Obviously, they were wrong on that. This is Redfin. Mortgage rates will gradually decline. This is your favorite type of
Yep.
chart, right, Will?
I love economists.
Right.
Really taking a chance there, aren't they?
Yeah. Here, can I draw on this? Can I get a marker? Phew, there's a line.
Perfect line. Yeah.
Perfect line.
Yeah. I mean, it is hard to predict. I get it, but at the same time, these aren't fueled by it's not it seems like they're not even looking at data to make
Right.
these predictions. They just, they'll go down because everything's rosy. But
Correct.
the reality is we don't know exactly what's going to happen, but these rates, the investors are looking at the data and they're going off of what the data is. If we can't trust the data because it
Mhm.
comes out and the government hired, 1.3 million jobs last year somehow,
Right.
and they're going off that data, they're like, "Oh, okay, well, we're going to keep our money in the stock market. We're not
Mhm.
going to put our money in mortgages." So
Yeah.
that means that there's less money in mortgage bonds to loan out to people because they want to make 8% in the stock market, not
Yeah.
6 or 7% in mortgages.
Right.
And
Right.
so,
And that's another reason why rates have to stay high is because there's
yeah,
a high return on investment in other places, which kind of so that kind of brings us to like 2025. I don't really want to have a big forecast or prediction for it. It's just I kind of want to bring up what I think is going to happen based on obviously new administration coming in, wrecking ball basically completely changing up the game, right?
yeah,
And so for mortgages, I think there's going to be two competing, like what is it? A unstoppable object versus what's the right word? An immovable object versus an unstoppable force, something like that, right?
hmm,
Like
okay,
which one wins out, right?
yeah,
And so you have the possibility for a booming economy, right? Low regulation, hopefully lower taxes, a lot of growth in the private sector, which is what we
hmm,
want, which typically that kind of keeps rates, I would say holds them. We saw the first Trump presidency mortgage rates kind of held. They were all in the fours and fives for the entire time, basically,
hmm,
right? End of Obama through 2019. Very, very solid, very steady. So you have that aspect where it would hold rates. Now, the other aspect is if they truly do cut the size and scope of government and get their fiscal house in order, debt going down, money printing stops, that could obviously lead to lower inflation. So that would counteract the growth of the economy, rising prices, right?
yeah,
So we'd have inflation coming down because the monetary system is stronger, right? So
hmm,
that could potentially bring rates down a little bit, right? That's the how I kind of see those two things playing out with a Trump presidency.
yeah, yeah. I mean, I think it's good to think about all the different factors that we're going to come across.
Right.
For the last several years, we've been in this environment of bad news is actually good news somehow, right?
Right. Right.
And it just seemed like everything that happened, it was spun in a way that it's actually good news. Oh, it's good that this is happening. It's
Yeah.
not bad, even though
Right.
normally, it would be considered a bad thing. So,
Right.
you know, we've been in this environment where all news is good news for stocks, and stocks have been going up for a long time. So,
Right. Right.
we'll
Yeah.
see. But one thing that we need to
Yeah, let's
talk
pivot
about
because
is
I guess the main crux of it is that it's so difficult, and we've gone back 2023, 2024, all the predictions on mortgage rates were wrong. Everyone was
yeah,
optimistic. They thought where they were going to come down and they remained really sticky, right? And we kind of think that's going to happen again. That's
yeah,
what we kind of feel like. I'm hoping that they do trend downwards, but the overwhelming feeling of most of the predictions out there already. I think they maybe have understood how wrong they were.
yeah,
Is that they may come down a little bit, but they're not going to like just shoot way down. Like we should expect them to be holding in this range, right? In the sixes somewhere throughout the year. So
Yeah.
the big pivot, which I think is the main thing you want to hit on today, is we're in Texas, obviously, right? Main markets for us, obviously, you, Houston, me, San Antonio, is the actual investment, right? Let's talk about the investment
Yeah.
and the potential gains of owning the home in Texas, right? Because a lot of these predictions also predicted housing prices to come down, which
Yep.
were also incorrect. So
Correct.
that's the main thing we're crux want to focus on today is that side of it, right?
Yeah. Yeah. And what we've looked at over the last, 20 years or so, I'll go ahead and share the screen. I mean, we've got this great resource, the Texas A&M Real Estate Group. I mean, this is a graph that shows all the migration into Texas. Okay, so
Yeah.
hundreds of thousands of people moving net migration into Texas per year. Another one that we really need to look at and focus on. So this is the Houston, Pasadena, the Woodlands, so the greater Houston area.
Hmm.
As you can see over the last 30 years or so, but let's focus on the last 10. It's a steady increase.
Right.
When we go over to San Antonio, it's the same thing. It's steady. Well, actually, San Antonio was pretty significant over the last 10 years up. Now it's trended down slightly, but that's also off of a few years of incredible growth. And
Ridiculous
so
growth.
yeah, and so anytime it's been flat essentially for a couple of years, it has restarted. If you go back to
Yeah.
2009, 2010, 2011, it restarts and goes up. And so
Right.
I
Scroll
guess
down a little bit on that screen. There we
yeah,
go. Nice, nice, perfect, perfect.
yeah, the
Yeah.
point is the year over year, waiting essentially waiting to buy because you want the
Mhm.
rates or you want the prices to go down. Prices aren't coming down. There's too many people moving to Texas,
Right,
and
right,
there's just a desire to own real estate in Texas and in San Antonio and in Houston. So prices aren't going down. The only thing that could happen is, deciding to rent for another year and losing out on what will likely be 2, 3, 4% appreciation, as well
right,
as that principal pay down.
right,
So,
right.
you know, it's
And the thing is too is right now, because of the market being the days on market for listings is still, I think it's still in the like 90-day range.
yeah,
So 3 months. Whereas, you could see like in 2020, 2021, those massive spikes. Days on market was like 10 on
yeah,
average. It was insane. It was usually first weekend, house is gone. I would pre-approve a client. Like 2021, I would pre-approve a client to go shopping for a mortgage for a home. I just didn't even expect to hear from them for like 2 months because it was that difficult to get under contract to find a
yeah,
house because there was so much activity. So to come off of those highs to be flat is impressive.
yes,
And the thing is, like, if we go back to the 2008s and you look at it in San Antonio, you look at it in the Houston area too, it kind of feels like we're in that same spot where in the 2008s, when the rest of the country, all other states were losing value, the state of Texas stayed flat, which is a
hmm
big gain, right? So
yeah,
now all we're waiting on, and I guess going back to the incoming administration, change of policy, low regulations, we should see, if nothing else besides like we don't know what's going to happen with rates, all that kind of good stuff. We should see a very big increase in consumer confidence.
hmm
So then people are getting either better jobs, wages outpacing inflation,
yep,
then people saying, okay, it's time for me to buy. Or you know what? I'm not waiting for rates to come down anymore. I'm going to sell my house and move into our dream home now because we're tired of sitting in this tiny house, right?
correct,
So
yeah,
we're in our starter home for too long, right? So that's what I kind of see moving forward is the consumer confidence angle. And this data that you're showing is lending confidence to your investment in that home in the state
yeah,
of Texas, right?
yeah, yeah, and when you really think about it, if it's a dollar amount that you can afford and you're happy with the house and you want the house, waiting is only going to it's only a risk, right? If the rates go down, you can always refi. If the rates go up, you're happy that you got it at a 6.75% rate or whatever it might be at
Right.
that time.
Right.
So and if the rates stay the same, then you're getting that appreciation and that principal pay down. But if the rates do go down over the next year and you released that house that you're renting and you got to wait a few more months before you can go buy,
Hmm.
and rates go down for whatever reason, maybe they go down a full point. Well, that just introduces another million buyers into the market,
Right.
and that
Right.
just increased the price of the home. So
Already on top of the people that are still migrating
yeah.
into the state, and because eventually the builders are not going to be able to build the homes fast enough, and your the existing home market is going to start to get reaccelerated again.
Exactly.
But yet again, yeah, good data. Will I think that yeah, moving forward, 2025 is going to be a good year. We're both already seeing more activity,
Hmm.
than the last half of 2024. It feels like there's some more activity in the market,
Yeah.
more questions being asked, more people kind of inquiring. So I think that all lends to us getting back to being more normal, right? I kind
Yeah.
of feel like I'd love it to have like a 2019, 2018 feel to it again,
Yeah.
right? So
Yeah, I think people are more accepting of the interest rates. It's every year more and more people are going to be, accepting of it. So
yeah, yeah,
that just increases more
yeah,
demand.
increases the demand.
Yeah.
So, and the supply right now is very low, even though days on market's longer than normal. It's still a low supply of homes just because the market,
Yeah.
the buyers aren't there. So those will
I
keep
bet if we
people
come
out.
back I bet if we come back in 30 days or 45 days and look at that average days on market, I bet it goes down significantly over the next 30, 45 days.
Yeah, let's take a look at that. Let's make a
Yeah.
note and see and come back and compare them. So, all right, thanks everybody, appreciate it. Yeah, another episode of Beyond the Rate podcast. Charlie will be back at you next time.